how did markets do in 2025 and what can we look forward to or be worried about in 2026? That's what we're looking at today. Cary Williams here, portfolio manager with North Road Investment Counsel, joined by my colleague, Marshall McAlister. Marshall, I'm going to share my screen and get us right into our year in review, which is what we're doing
Very good.
today.
Has it been a year already, Cary? My
Oh
word.
man. Yeah, it has just flown by 2025. I can't believe how much has happened this year. Why don't you start
Mhm.
us off? I'm going to flip to our team update. Why don't you start us off by talking a little bit about what's happening at North Road?
Very good. We have continued to expand the team. Happy to announce another associate advisor joining by the name of Tim Goodkey to our team. Tim's going to be working really closely with you, Cary,
Mhm.
as a kind of a supporting service advisor on your service team. And Tim joins us from another firm in Edmonton and has a financial planning and an advising background. And really great to have him on the team. So welcome, Tim, as you watch this for yourself. The financial planning work is still continuing to really build in our firm. Last year, we launched a fee-only advisory service, primarily to support some of the kind of connections that our clients have who may not have the assets to hire us kind of officially for our asset management work. So we are giving financial advice and doing investment advice for folks that are kind of new to the savings world, as well as folks that potentially might take a bit of time to transition into the investment work that we're doing. Um, I'm seeing this as a really important program for our firm, Cary, and I'm actually having a lot of fun delivering the service as well.
Yeah, I've noticed in particular, Marshall, that the professionals we know in the industry, such as accounting, lawyers, those types of folks are really finding this valuable in their practice where they can have somebody that can be hired on a project basis for their clients, as an example. If even if those clients don't want to become investment clients, as an example, they just need project work to do some
Yeah.
modeling around financial consulting. I'm seeing a lot of pickup around that.
Yeah. And the other thing that I think it's important to mention is now our clients can refer a friend over and they don't have to
Mhm.
ask about level of assets that they have, and they don't have to worry that we're not going to take them on. And anyway, so my message to the client base today is we're here to help, no matter what. And just keep us in mind if somebody comes to you and saying, who do you go to for this finance question or this investment question? Yeah, do come to North Road. We have some important, I think, improvements that we're going to be making to the digital risk advisory
Mm.
program. I know you brought up the insurance. Maybe I'll just finish off the digital risk thing first. We're going to be introducing some safe word management to our client base. So in the first quarter, we're trying to get as many of these safe words updated with our client base. So do get ready for that. Insurance continues to be a service that we're providing here in Alberta and British Columbia. So we're helping kind of younger clients get coverage and also doing some planning using insurance. And what did I miss, Cary? I think that's got the other. Those
Yeah,
are
I
the
think
kind
that
of the
covers
service
most of it.
lines.
Yeah, the updates on that. I think it's important for us just to touch on TFSAs and RSPs and FHSAs, all those registered programs, working our way
Mhm.
through helping folks contribute to the TFSA, $7,000 again in 2026. RSPs, I think most folks are pretty comfortable with. These tick up with, with wages and inflation and things like that as well. FHSA is pretty new. This is the first home savings account. Just a reminder, $8,000 per year after it's open, up to a maximum of $40,000. Marshall, the way I like to describe it is it's kind of a combination of all the rules all together. It's an RSP, it's a TFSA, and it's an RESP set of rules all combined into one. If you put money in there and you take it out for a house, you can take it out tax free as long as it's used for a property. If you put it in there, you
Yeah.
get a tax deduction like an RRSP. But if you don't contribute in a year, you can only go back 1 year in order to grab previous room like an RESP. So it's got all these kind of mixture of rules all in one, but great for folks that are saving up for a house.
Yeah, absolutely. Or parents that want to help
Hmm.
18-year-olds start to save, do consider this as a program to help them save. As you mentioned, Cary, you lose the contribution room if it's not used. So there is kind of a ticking time bomb with this planning with the first home savings account. Our team has been working really hard. The first few weeks of every new calendar year, we do a huge amount of contributions, trading, minimum withdrawals from registered accounts, and as our clients will see, most of the tax-free savings accounts and such have been contributed to already.
Yeah. If you haven't heard from us, trust us, you are on our mind. You will be hearing from us very, very shortly. I've got a pile of emails, Marsh, ready to go to clients to say, hey, Tim's going to reach out to you to book a meeting. Let's get going. So
Yeah,
look forward to that for sure in the next couple of weeks. Marshall, let's touch on 2025. I wanted to start with the timeline because 2025 flew by and it was wild. I think about what happened starting in January. So the Trump inauguration happens. Then we get this announcement on DeepSeek, the AI model out of China, and NVIDIA just drops like a rock. And some of the AI stuff we go, holy smokes, maybe the US is not the center of the universe for AI. Then we get a little reprieve, and then March happens, and we get this Liberation Day announcement, right? Tariffs are coming. Everybody be ready. It's going to be huge, as the Trump administration likes to be spectacular. And then April 2nd comes, and that board goes up at the press conference with these enormous tariff numbers, right? And all of the chaos that creates right after that. And so I don't know about you, Marshall, but I had a number of folks reach out right after that to go, what is going on and what do we do?
Mm-hmm. Mm-hmm.
Yeah.
Agreed.
And then, go ahead.
No, it was a pretty high stress moment in our year.
Yeah, absolutely. And then 7 days later, the tariffs get paused, right? And markets rip. It was just a wild couple of weeks. So one of the things we really told folks was, hey, let's be patient. Let's see what happens. Let's not make, knee-jerk reactions and make decisions. And if folks had sold as those tariff announcements hit, there was a lot of pain and missing out on the upside that happened after that, right?
Yeah, there definitely was some good returns through 2025, potentially unexpected good news in terms of the returns, considering the news that we had to live through.
Yeah, absolutely. And then, to finish off the year, we get U.S.-China tariff deal finally in May after the ups and downs of the announcements. Then in June, Israel strikes Iran, right? Just a wild situation there. Then we get another tariff announcement and modified tariffs in August. And then we're into October and the government shuts down in the U.S. for the longest period in history. And then we're in December and Iranian protests, and the whole time markets over the year go up. Not in a straight line, but the year turns out to be pretty good.
Totally. There's lots of Post-it notes that we didn't put on here because it would have gone on forever. We talk about Russia, Ukraine. We talk about Gaza. It just goes on.
Yeah, exactly. So let's get into market returns and just see how the year was. On screen here, we've got Canadian returns, large and small, for 2025. And I think most folks would be potentially quite surprised to know how much small Canadian companies or smaller Canadian companies produced last year. It was an outstanding year, primarily driven by materials. We'll talk a little bit more about that later in our presentation today. But 50% 1 year return for small indices there, and beating large indices over the 3 year period.
Yeah.
Similarly, value beating growth over the 1 and 3 year periods. So those value and small focused portfolios did really well this year. On the U.S. side, a different story. Continuing with the trend of sort of the last decade or so, large companies beating small companies over the 1 and 3 year period, and growth beating value. We're going to see international markets here in a second, Marshall, but this does seem to be the continuing kind of anomaly when it comes to factors like large versus small and value versus growth. The U.S. is not tracking the same way Canada and international markets are.
Yeah, you can see that.
Yeah. On the international side this year, small slightly beating large, not so much over the 3 year period, so not as consistent as in Canada there, but value significantly outperforming growth over the 1 and 3 year periods internationally. One of the questions I've had from folks, Marshall, is just like, why is international suddenly coming around? Why is international beating the U.S.? I thought I would put this up, and I'll just draw on here to draw some eyes. But we've got on the top line Europe, and on the third line the U.S. S&P 500, and we can see 2014 to 2024 in that compound growth rate there. The S&P 500 significantly higher than Europe. But when we look at projections moving forward, almost in line. So we had lower valuations in Europe, as an example, internationally in most cases, but expectations for growth coming back in line despite what we saw recently. So you've got lower valuations and you've got similar growth rates. That likely justifies this bounce back that we've seen in the international side. Anything you want to add there, Marshall?
I think the idea that diversification is always about making your portfolio safer is missing more than half the story. Diversification forces us to be in areas that we might miss, and us chasing the hottest returning asset class or economy last year would have had us miss some big numbers outside of North America and even Canada having a significantly higher rate of return than the United States.
Yeah, if we go back to January 1st, 2025, Marshall, and we look at some of the surveys from around that time period, it was not common for folks to think that international was going to beat the US. There was definitely a feeling that US exceptionalism was going to continue, that Europe was going to, continue to be in malaise and international, and China was having challenges with their real estate market that was going to drag the economy down, and all those kind of things were in the news. And then lo and behold, at the end of 2025, we get a surprise, I think, compared to those headlines and those feelings.
Yeah.
On the momentum side, Marshall, not quite as good as the international value side, but definitely a good year for momentum again. This global momentum is focused, about 2/3 in the U.S. and about 1/3 outside. So definitely a global focus there. Bonds, long-term versus short-term bonds, both global and Canadian here. Lots on this chart, so I'll just highlight a couple spots, Marshall. Down here at the very bottom in red, we can see the long-term Canada bond index. And not just in Canada, but the U.S. as well. The rising rates that happened in 2022 have really hurt long-term bond returns, and we just haven't seen much relief from those. 3-year return of 3%, I mean, is not zero, but it has not been a smooth ride for folks over the 2022 to 2025 period. And then short-term doing much better than long-term on that end. Global, slightly less than the Canadian side, but reasonable returns, I would say, for especially for short-term investors or short-term bond holders, I should say.
Yeah, I agree.
REITs, so real estate income trusts here. This is showing in US dollars so that we can compare Canada versus the globe in one currency. We can see that Canada at 10.73% for 1-year return outperforming global REITs, but the opposite over the 3-year period. So again, diversification is helping out.
Yeah. REITs have been a tough place to invest in years past. So good to get rewarded this year.
Yeah. And a big swing compared to sort of pre-COVID, where REITs were one of the better performing asset classes globally, right? Yeah. A note here just on currency. So what we're showing on the screen right now is the S&P 500, both in Canadian dollars in green and in US dollars in blue. And you can see that the 1-year difference is pretty significant. The US dollar had some challenges this year, fell in value, and our return as Canadians as a result was less than it would have been in pure US dollars.
Yeah.
Okay, Marshall, can we move on to 2026?
Let's move it.
Okay. I want to touch on a few topics that I think folks are asking about, that they're thinking about. And one of them that has come up quite a lot is this a bubble? Are we in a bubble? Because we've seen a couple of years, almost 3 full years of really good returns, double-digit returns in stock markets in a lot of cases. AI is all over the news. It's exploding. It's the new technology. Is this the .com boom and bust all over again? All of those things, I think, are things that folks and investors are thinking about and questioning. So I want to start by looking at the yes side of that equation. Let's show a few images, a few charts here that show that yes, there's a good chance that we are in a bubble and or moving into a bubble. Okay. Starting this one with valuations. So this is the S&P 500. It's going back to 94, and it shows valuations, both the 30-year average valuation in this case, in the middle, which I've marked here with the red star, and then one standard deviation up and one standard deviation down, so that folks can get an idea of where are we compared to the last few decades of history. We can see on towards the left side, I'll circle here, sort of 1998, 99, 2000, and the dot-com boom. And over here, we're ending 2025 in, I would say, sort of the same realm, if we put it that way. 22 here as the valuation that's showing forward price earnings ratio for where we're at. Okay, so I think that drives a lot of these questions. Are we in valuation territory that makes this really challenging and potentially bubble-like? Anything you want to add, Marshall?
Nope.
Okay. Part of the conversation here is the capital expenditures happening in tech right now, in particular AI data centers, is enormous. And so when we get lots and lots of spending happening, someone is reaping the rewards of that. In this case, lots of the infrastructure that's happening around AI and data centers. And this chart that we're looking at shows a number of the US previous infrastructure buildouts, including the 2000 buildout here in gray, and then where we're at right now. And this is as a percentage of GDP. So the sort of denominator on this is the GDP number. And we can see that the tech build out in 2025 is a big, big number. And to compare it, they look at the other examples of this infrastructure build out combined are only slightly above the tech build out we're at now for things going back to sort of the 1930s to 1960s, that big sort of pre-war, post-war build out. And so broadband CapEx expenditure in 2000s was very, very large. That led to this kind of boom and bust cycle. And now the question is, okay, is this tech build out also going to lead to this boom and bust cycle? Why is this important? Well, this chart that we're looking at right now shows that as capital expenditure grows for firms, in general, we see this underperformance for firms that really sink a lot of money into capital expenditure growth. And so there is this concern in the financial world that says, if we go from having tech companies that are cash flow rich, so to speak, that are producing lots and lots of cash flow, and suddenly they're putting lots and lots of money into capital expenditures and into build out, do we get poor returns moving forward? And last but not least, what are the sectors that are doing the most build out right now with year over year change? It's technology and communications. So it's that AI oriented sector, a couple of sectors right there. Okay. How'd I do in explaining the capital expenditure build out and concerns there, Marshall?
Yeah, that makes sense to me.
Yeah. And then this one shows us the debt as a part of US investment grade debt that's out there. So public markets, investment grade. And you can see here in green, we get this enormous jump at the end of the year in tech as a percentage of the investment grade index, with debt being added on to this capital build out. So the concern with any sort of bubble is once debt starts getting applied, does this become a runaway expenditure, and does this become a problem versus valuations and profitability? All right. Okay, Marshall, let me hop to the nope side. Yep. This is not a bubble. We're doing A-OK. I want to start with this chart here that looks at what happened right after that debt jump in kind of October of last year. And you can see there was a big announcement right there, Marshall, in October, particularly from Oracle around what they were going to do as far as debt. And other companies like Meta and other tech companies that are really into this AI build out started to announce more debt-like instruments and more debt coming on board. And what we saw was markets do their job. Markets said, you know what? We know what happens when debt becomes a problem. And we're going to start to sell off these technology names at this point and look at other names in the S&P 500 that are not in tech. So to me, Marshall, this is markets recognizing that something has changed, that there is a potential higher risk here around this debt issuance, and now starting to look at other opportunities. In addition, I would say on the no side to a bubble is, even though price earnings were high in the previous charts I showed you versus history, over 2025, the price earnings ratio actually didn't change. It was almost exactly flat from where we started the year and where we ended the year, despite changes in price on that end. So I think markets are really doing their job. They're really trying to weigh, what do we do with these companies that are or have been the most profitable in, I would argue, without extreme statement, the history of the world, suddenly now taking on debt and taking a different approach to their business. And what do we do with that?
Yeah.
All right. And last but not least, I want to highlight two things. One, earnings growth. So profitability, earnings were the driver of most of the return in the S&P 500 when we look at it. It wasn't multiple expansion. It wasn't that price earnings ratio. That's the part that's hard to replicate into the future. And so when we have businesses that are doing good work, that are growing their earnings, they get rewarded. And we saw that this year with nice returns on the S&P 500. Okay. And last but not least, this chart is a nice one for showing what has happened in previous booms. And we get this real sort of what's called a blow off top in the last year of the bubble. We get this almost parabolic upswing in the last year. And we just haven't seen that in the US tech at the very least. Right. So I'm using US numbers here in particular to just sort of highlight that there's a reason why markets have gone up. Around earnings and growth and that side of things, some excitement around AI, but I think it was held in check overall by markets as debt was added. Markets pulled back and got worried, let's say, and started to reanalyze what was being allocated to these tech names. Yeah. All right. Anything you want to add, Marshall?
Nope.
Okay. I want to talk about what happens if things go right, Marshall, because often you and I really focus on talking to our clients and investors about risk and managing risk. Yeah. So let's talk about what goes right. Last year, I said in our presentation, year in review, listen, I think we're in the middle of a bull market, and in a bull market, you got to grab the horns and ride.
All right. So what does this mean for markets? Well, I will go on the record now, Marshall, to say I feel like we're in a full-blown bull market. We're running with the bulls. Last year was a phenomenal year for markets as far as returns.
And so even if we get a bit of concern, you got to stick with it. And I found this chart that I think perfectly highlights why we got to think about what happens in these moments if things go right. So this looks at bull markets going back to 1949 in this case. And it says, how long did each bull market last? What was the average? What was the median? And we can see on the right side over here, average and median bull market. There's not a lot of instances here of bull markets, but it gives us a bit of an idea. So some of the bull markets are short, right? This is the one we're at right now at 38 months, starting in 2022, October. And we can see that some bull markets last a really, really long time. And so there is a chance that this bull market lasts a really long time. And this is not the peak, so to speak, of a bubble.
Yeah.
I'm going to use the NASDAQ here during the boom years, Marshall, as an example of this. So what I've got up here is the returns, calendar year returns for the NASDAQ in US dollars. And we see double-digit returns for 5 straight years, with that blow off top in the very last year that I mentioned at 86% on the NASDAQ. Now, this is not a diversified index whatsoever. This is very tech heavy, right? But it does give us an indication of, in these moments of change, if things go right, we can see really, really outstanding returns. Yeah. I don't know if you remember the headlines here. I want to talk about it, Marshall, but I remember hearing about Buffett being thrown under the bus here, that he'd lost it, that he was sitting out this tech boom, and he didn't participate in a lot of this upside at the time, right? And he was saying, listen, valuations seem crazy. I can't get into this. I'm going to sit it out. Do you remember that?
Oh, for sure. Yeah, for sure.
I remember my roommate at the time telling me about this thing called Amazon. And this is the guy who was studying at the time to become a helicopter pilot. And he's like, dude, you got to put money into Amazon. It's going crazy.
That's wild.
Yeah. Okay, let's touch on our usual, which is what if things go wrong, our risk management, okay? And a couple of areas where I think we could see some bumps in the AI story. So lots on this slide, but this is some analysis that came out in December of 2025, looking at how often AI models hallucinate or give incorrect answers, responses to questions. And we can see on the far left side, the very best models showing sort of a 30%, let's call it 20 to 30%-ish, incorrect response rate. So these things are not perfect, right, Marshall? We gotta use any of these AI tools with eyes wide open. And if we go all the way to the right, we see that some of the worst models are pretty darn bad. 70% potentially in incorrect answers. Okay. So the amount of money flowing into this area right now, where it is not providing correct answers, could be viewed, I think, as a real problem. The other side, and I think I mentioned this in last year's video, is energy consumption. Data centers are using a ton of energy, and it's really going up quickly. So this is a chart from International Energy Agency, some data from them, just looking at electricity consumption by U.S. data centers and some projections. Projections are always tricky to know for sure if they'll play out, but pretty large increase to data center electricity consumption expected as a result of this build out. Yeah. Do we get to the point where we've got the energy to support that? I think that's the question, right? And in the U.S., actual numbers here around the U.S. households, what they're paying for electricity prices as demand has increased across the spectrum from residential to this commercial and to data centers. And we see this really big jump sort of post-COVID and into recent history here. And it doesn't appear to be slowing down. So I think, there's a chance this becomes a political issue this year in the U.S., right, Marshall?
Yeah, it could. Yeah, it definitely could.
Okay. So what happens if things go wrong? Well, this is the other side of that NASDAQ.com boom slide I showed earlier with the 5 straight years of double-digit returns. When the NASDAQ boom did pop, we had 3 double-digit negative return years in a row. Now, not strictly because of the bubble per se. I mean, 9/11 is also in there. So we got this double dip in a way, but some pretty gnarly years post bubble as well.
Yeah, for sure.
Anything you want to add to think about there, Marshall?
Well, I think in terms of when we build portfolios, I think we focus on more around what we don't know, and we don't know what the future is going to hold. We can kind of have some guesses and look at what trends are, but we really, really lean on diversification. So we're not abandoning the United States, but we are lowering our exposures. We have a consistent approach to value, which says we're not going to own businesses that have super high PEs at the same level that the markets are owning it. I mean, 2025 is a fantastic example of how our diversification really just lifted everybody's wealth program higher. Then we trend followed and did what the markets showed us in 2024 and did the same thing in 2025.
Yeah, I think in addition to that, we do take this approach where we don't own, quote unquote, the market, right? Yeah. So to your note about value, I found these 2 charts that I found really, really interesting. So this is, again, the .com boom and bust. The left side is the lead up. So we can see that kind of blow off top in momentum or primarily tech-oriented companies. The value and quality-oriented companies trailing pretty significantly into the boom. And then we flip to the other side from March 2000 to April 2000 and the next kind of 4 years-ish there. And we see the exact opposite. We see value at the top and momentum trailing pretty significantly in that bust. So even though the NASDAQ busted, so to speak, it doesn't mean that all areas of the market were having trouble. Value really picked up the baton, so to speak, there and kept running for portfolios. So recognizing that diversification beyond just asset class and geography and into style, as an example, what we call characteristics and the academic call factors, can make a big difference.
Yeah.
Okay, Marshall, one area that I'm getting a lot of talk about, and I'm a bit salacious here in our intro slide, that markets don't care about our politics. Right. I've put it this way on purpose because we're seeing a ton of change in the political macro landscape right now. Some would say it's a regime change and the world will never be the same, as we heard recently from some of the more public politician speeches. But I want to touch on whether or not that should impact our portfolios. And so I got a couple slides, again, a bit US focused, but I think it's going to help us explain the story. So what this shows here, Marshall, on this slide is going back to 2002, and in blue it shows how many of Democratic voters expect stocks to go up in the next 6 months, and then in red, Republicans. And we can see that their expectations for the folks that were surveyed by Gallup here are all over the map, depending on who's in charge. Right. So the person that holds the same values as us, maybe politically, we suddenly feel optimistic about the future. As soon as those other guys are in office, we suddenly feel really pessimistic about the future. And yet markets have done okay, even with a few bumps along the way, right? So we can see going back here to 1900, US market continues to do its thing and reward investors who stayed invested through the bumps and the different presidents and folks in power. Anything to add there, Marshall?
Nope.
Okay. All right. The other question I'm getting a lot, Marshall, is should I own gold? And I guess it's no wonder gold was up significantly in the last 12 months. And so anytime an asset is increasing in price, we're going to get questions on it. And I wanted to highlight a couple of reasons why we don't hold gold as a specific line item in portfolios, but our portfolios absolutely reap the rewards of gold if it goes up and of course, feel it as it goes down, or can at the very least. Okay, this is really interesting research that came out. It's the annual gold and S&P 500 returns going back to January 1975 to March 2025. So relatively long time frame, looks at some inflation periods in the 70s and everything in between. And I want to highlight two things here, Marshall. So S&P 500 monthly returns on the left, gold on the bottom. This on the bottom right quadrant is when gold has a positive return and equities are negative. So if gold was a diversifier we wanted to hold, we would want to see lots and lots of blue dots in that sector, right? Where it's going up when our other stuff is going down. On the left side of that is when gold and equity returns are both negative at the same time. Okay, we don't want this because it doesn't provide diversification. And look at this, 20% is on the right side, 18% on the left side.
Yeah.
Right. So is there a benefit to us in holding gold because it goes up when markets go down? Not really.
Yeah.
Right?
Pretty random, right?
Pretty random. And gold goes up when markets go up, the top half, 60% of the time. So is it really something that adds to our portfolios, makes them more diversified? I would say arguable at best.
Yeah.
How's that? Did I do okay on that, Marshall?
Yeah.
Okay. I also found this chart, which I found really, really interesting. It looks at average returns. That's kind of the light orange line there. And then it looks in these pink boxes at one standard deviation around average. So sort of what you might expect returns to be in any annual year. And then in the green dot where we were this year. So take a look on the left side, Marshall, at just how far above gold was compared to its average.
Yeah.
Right. So when we look at gold versus other asset classes in 2025, yeah, it was the anomaly.
Yeah.
Very, very different from what one would expect looking at the history. Okay. Can we expect that again? Probably not.
Yeah.
All right.
Making a forecast.
Yeah. Yeah. Compliance would appreciate if we didn't make any forecasts on the price of gold, right? Yeah. Okay. Let me tell the folks watching, Marshall, why despite not holding gold in our portfolio, they still can feel okay about gold. Okay. So here's the very quick back of the envelope math for me. The S&P TSX, so Toronto Stock Exchange, this year, 31% return in 2025. Materials, which includes gold, so this is sort of your mining bucket, your mining sector, makes up 18% of the TSX. So call it 20%.
Not the return, that's the weight, right?
That's the weight. Yeah. 80%. The rest, the other 80% are financials and technology and all those other sectors. Okay.
G's a big part of it.
Yeah. This year, the materials sector, so gold and mining, went up 99%, almost 100% return. Unbelievable. Just like a phenomenal year. One of those, as we saw in the previous chart, one of those very special, out of the ordinary kind of years. All right. So if we just do the quick math and say, okay, about that materials would have provided about an 18% return of the 31, we get roughly 40% of the TSX gain this year came from materials and gold.
Yeah.
Okay. Gold is 75% ish of the materials sector of the materials index in Canada. So it's the biggest chunk of that. So we have exposure to gold. We just don't
Yeah.
own bars, so to speak, right?
Yeah. Yeah. We
As
own businesses
Canadians,
that make money on it.
yeah, and as Canadians, we get to reap in the rewards of that when those mining companies do well, and reap in the losses when they do poorly if gold falls.
Yeah.
Yeah. So I feel pretty comfortable, Marshall, even in years like this where gold is just ripping, that we're going to see some exposure to that, and we're going to enjoy it.
That's right. And if the stats were different, if we had more of a diversification statistical benefit, we would own it.
Yeah.
It would we wouldn't care. We'd just like throw it in there. But yeah, we just don't see the results. It's just not good enough for us to include it in the portfolio.
Yeah. On that note, Marshall, I want to show a few slides here on what normal markets look like, quote unquote, because I don't know about you, but I've had a number of clients who've said, hey, we've had really great returns. Do I need to change something because I must get negative returns soon, right? And I just want to touch on why we don't predict and why we just try and be diversified through markets. I found this slide fascinating, Marshall. So we hear this quote or this idea that U.S. markets have provided 10% per year in returns. But if we only look at the up years and find an average of all those years, and the down years and find an average of the down years, we get an average of 21% return in the up years and minus 13 in the down years. So that 10% is there, but in any positive year, it's much, much higher than 10% on average. And in any negative year, it's lower on average. Yeah. And so if we expected next year to be a negative year, as an example, we can't predict that. But if we did, this would be the most likely sort of prediction there would be like in that range. And so most of our clients, and I think most investors would be like, oh, okay. That's not a rip your face off negative expectation, right?
Yeah.
Yeah. How'd I do there, Marshall?
Yeah, that's good.
In addition, I think we've talked to clients a lot about this. The longer we hold investments, the more likely it is that we get positive returns. So this chart looks at holding periods from 1 day to 20 years, and we can see the rolling period since 1950, and we can see that higher returns for the S&P 500 get more and more likely as we go out. Okay. The flip side of this is also that it's incredibly normal the longer we hold to experience a bear market, to experience a market of more than negative 20 returns in a short period of time. So holding for a long period of time means we get more likely positive returns and we experience intermittent negative returns. Okay. And what does that look like? Well, this chart shows us how often negative returns show up in a year going back to 1928. So a 3% drop in markets happens about 7 times a year. Totally normal, very, very, very common. 3% or a 5% correction happens about 3 times in a year. 10% just over once a year. 15% drop in markets happens about every 2 years on average, and a 20% drop happens every sort of 3.5, 4 years. So these are common. As investors, we just have to expect this is going to happen in markets, and we have to be willing to hold through these moments. Marshall, I wanted to leave folks with a bit of optimism as we go here as to what 2026 might look like. And so I found this chart. There's lots here, but I wanted to highlight one thing, which is when the first 5 days of the year are higher, going back to 1950, we get nice returns, at least in the data set on average. So no guarantees, but a start of a year can be, in the historical data, a good omen for the rest of the year.
Okay, well, hopefully that pans out. In closing, I'd like to say that our Prime Minister delivered a really good speech at Davos in Switzerland this week. And clients, if you haven't watched Mark Carney's speech, I think it's worth. I think it's about a 15-minute talk. Spend some time and hear his message. I was quite impressed by it.
Yeah, some really interesting terminology and verbiage used, right? It was very pointed and very thoughtful at the same time.
Yeah.
On that note, Yeah, absolutely. On that note, Marshall, I want to highlight two things for folks. The first is that on the screen, we've got a timeline of a few things that are happening in 2026 that we know of. It's the surprises that always affect markets the most, but here's a few things that may create what I like to call a bit of a silly season. So November, we've got US midterm elections. Right. So we're already starting to see a bit of silliness here as the Trump administration tries to convince voters that they deserve to have their friends elected into that midterm election. In July, we've got the official joint review and renegotiation of the Canada-U.S. trade agreement. So some of the things we're hearing on the news, both from Canada and the U.S., is likely to soften the negotiation and or contribute to it on that end. In May, we've got Fed Chair Powell ending his chair. So we're going to hear more about that. We've already started to hear chatter around this, and he came out with this video recently that folks can check out that's making the news. So lots of sort of posturing around that and what that might be. And then Trump is visiting China in April. So there will be another round of posturing, I'm sure, around that for sure. So just a reminder that it's normal for markets to go up and down, to try and price in what's happening in the world, and patience is a virtue. Okay, Marshall, that ends our chat for year in review. What did we miss?
Well, we missed some stuff for sure, but this would have been a 4-hour talk, so we have to wrap it up at the hour mark for sure.
Totally. Yeah. Hopefully that's helpful. I want folks to know that they can reach out to us anytime if they have questions on this presentation or anything else happening in their portfolios or in markets. We are staying on top of what's happened in the news, providing a helping hand, trying to hold hands when they need to be, and give high fives when folks are making great decisions and having fun and creating joyful lives with their money. So if we can help out at all, let us know, please.
Yeah. And if you've made it to the back end of this video, you get a reward. Just let us know, and we're going to buy you lunch. Okay. So
yeah, that's right.
Thanks for hanging out.
You get to decide which team member you gets to take you for lunch.
Yeah, that's great.
Awesome.
Yeah.
Awesome. Okay. Thanks, Marshall. Appreciate it.
All the best.